All right, let's talk about something you hear constantly in the financial news: the Dow, the S&P, and the Nasdaq. What are these things, really, and why do they seem to tell different stories? Let's break it down.
You've definitely seen a headline like this before, right? It's super confusing. You're thinking, wait, what? How can one be up, one be totally flat, and another be crashing, all at the same time? Aren't they all just the market? Well, kinda, but not really. Stick with me, because in the next few minutes, you're going to know exactly what's going on, and more importantly, which one you should actually be paying attention to.
Okay, so let's kick things off with the big one, the OG, the Dow Jones Industrial Average. Pretty much everyone just calls it the Dow. It's the oldest, it's the most famous, but, well, it's also hiding a pretty big secret.
And here it is. This is the plot twist. The Dow, this index that's supposed to represent the entire U.S. market, tracks only 30 companies. Yep, just 30. That's it. And, right away that should tell you that something might be a little off here.
On top of that tiny number, there's another kind of quirky thing about how the Dow works. It's price-weighted. Now, that sounds technical, but all it means is that a company with a higher stock price has more pull. So a stock that costs, say, $300 a share moves the index way more than one that costs $50, even if that second company is actually way, way bigger. It's an old-school method, and the companies it tracks are those classic blue-chip giants, the household names like Coca-Cola, McDonald's, and Visa.
So what's the bottom line? While the news absolutely loves to quote the Dow, it's not really a great picture of the actual U.S. economy. Because it only has 30 companies and uses that quirky price-weighted formula, it's really more of a historical headline number than a useful modern tool.
Okay, so if the Dow is the old-timer, who's the real player in the game? Well, that brings us to the S&P 500. And honestly, this is the one that most professionals consider the true pulse of the market. If you want the best overall picture, this is the one to watch.
And the biggest reason why is, well, it's right there in the name. Instead of the Dow's little club of 30 companies, the S&P 500 tracks 500 of the largest companies in the United States. I mean, just with that number alone, you're getting a much, much broader and more accurate sample of the economy.
The S&P also uses a way smarter system. It's market cap weighted. All this means is that bigger companies, the ones with a higher total stock value, have a bigger impact. So a monster company like Apple is going to move the index far more than a smaller $50 billion company. Which just makes sense, right? It's a much more logical way to measure the market's health.
And this is exactly why the S&P 500 is considered the gold standard. It's broad, it covers all the major industries, and get this, it represents about 80% of the entire value of the U.S. stock market. That's huge. It's the benchmark that nearly all serious investors and index funds use.
Now for our third pillar, the Nasdaq. This is often the most misunderstood of the bunch. People hear Nasdaq and they immediately think tech stocks. And you know what? They're not wrong. This is the index for growth and innovation.
And if you thought 500 companies was a lot, check this out. The Nasdaq composite includes over 3,000 companies. 3,000! It absolutely dwarfs the other two. But it's not just about the sheer size here. It's about the kind of companies that are inside.
The Nasdaq is super concentrated in technology and other high-growth sectors. We're talking the titans of tech: Apple, Microsoft, NVIDIA, Amazon, you name it. And because it's so focused on this one aggressive part of the market, the Nasdaq tends to be way more volatile. It's a bit of a roller coaster. It rises faster on the good days and, you guessed it, falls a whole lot faster on the bad days.
All right, now that we've met all three players, let's put them head-to-head. This is where it all comes together and the differences become totally crystal clear. Just look at this breakdown. For size, it's not even a contest. 30, 500, and over 3,000. For focus, the Dow is classic companies, the S&P represents the whole economy, and the Nasdaq is all about tech and growth. And that focus directly leads to volatility, doesn't it? The Dow is the most stable, the S&P is in the middle, and the Nasdaq is the wild ride. Honestly, this table is pretty much the key takeaway.
So this brings us all the way back to our original question. With all this info, which one should you actually pay attention to when you see those confusing headlines?
Here's your simple playbook. Step 1. If you want the best overall picture of the U.S. economy, you watch the S&P 500. Period. That's your main dashboard. Step 2. If you want to understand what's happening specifically with tech stocks, you look at the Nasdaq. And step 3, you can use the Dow for a quick historical glance, but just know what it is: a very, very limited snapshot.
And to help all of this really stick, I've created a clean, visual, one-page summary of this entire explainer on a free Notion page. You can read it or even duplicate it for your own notes. The link for that is right in the description.
If you found this helpful and you want more lessons just like this one, please hit that subscribe button. It's the best way to make sure these explainers keep coming. Thanks for learning with me today.